Good morning, ladies and gentlemen. I thought this week we would start with one of my favorite quotes from Jeremy Grantham, who is a very famous British investor, and this is very appropriate for this moment in time. Investment bubbles and high animal spirits do not materialize out of thin air. They need extremely favorable economic fundamentals together with free and easy, cheap credit, and they need it for at least 2 or 3 years. Importantly, they also need serial pleasant surprises in such critical variables as global GNP growth. Exactly the situation we have here at the moment, and exactly what we are in. We're in a bubble. If you look at a chart, a long-term chart of the equities market in the States, this is SPX, it is very difficult to argue that this is not a blowout phase during a bubble. We have zero, this is a weekly chart, so we can't really see it that well, but we have zero retracements. Every retracement that we have, however small, gets bought. The market is trading through the top of the Bollinger Bands in the dailies, the weeklies, the monthlies. It is now going towards the absolute top of the channel that has been it's been in since 2009, which is somewhere around the 2600 mark. It is definitely a valuation bubble. We are trading at ridiculous valuations that people are justifying through economic fundamentals. What they do not realize is that the economic fundamentals and different things like the tax plan have been in the market ever since these levels. So these are the levels that the market started discounting, and now this is just a bubble. These are people getting in far too late, giving up on any other view apart from the one that says the market is going to go up forever. Well, it might go up forever, but before it does that, I am absolutely convinced it'll spit them out by retesting the bottom of this trend line, some around the 2200 to the 2300 level, and so we're in for a period of unprecedented volatility at some stage. The only question is, what is going to trigger the burst of the bubble, and how do you trade a bubble? Well, the way I trade a bubble is by waiting for the monthly market to get to the top of the Bollinger Band, and then by buying puts. That is the only safe way to do that. So basically what we're now waiting for is 2601, which is the top of the Bollinger Bands, where we buy puts, at the money puts, waiting for the retracement. It is very important not to try to top pick by selling the outrights. Options at the moment are so cheap that it is far, far more productive to trade in options than it is to trade in the outrights. It is always useful to look back at the manias that we've had in the investment world. This is NQ back in 2000, and you can see how the market traded up to the top of the Bollinger Bands and then absolutely collapsed in the period of 3 weeks. Went from the top of the Bollinger Bands right to the bottom of the Bollinger Bands in the space of literally 3 weeks. That is the kind of ridiculous situation that we're in at the moment, and that is why it is so much better to play in options as it is to play in the outrights. It gives you so much more flexibility, and that is what we are going to start doing as of next week, because the situation is definitely ripe for it. The most important takeaway we have from last week is that not all equity markets are in sync. Here we have an hourly chart of the DAX, and as we can see, it is now testing the 200 moving average. While the SPX is ramping ever higher, this market is failing on the upside and is testing the downside. We think that at this juncture in the market, you have to trade every market for itself. You mustn't correlate them because the correlations are breaking down and individual markets are showing their true colors. Here we have the DAX, and in a moment I'll show you the stocks. It is on the verge of breaking down, and that is why we sold stocks as opposed to selling the SPX. And this is the hourly stocks. You can see how this is even weaker than the DAX. We are now contracting in the Bollinger Bands, which is a sign of volatility to come. And when we start breaking down, if we start breaking down, this could be a very rapid move to at least this level around 35.25 area, 35.20. It could be a very, very, very steep and fast fall. So we're going to trade every market for itself, whether it be stocks, whether it be DAX, whether it be Nikkei, whether it be SPX or NASDAQ or Dow. They are all in different phases. None of them are correlated. The correlations have broken down, and it is time to sell the weak and wait for the bubble to burst in the very strong. This is an hourly chart of the NASDAQ. If we start breaking down, it is very reminiscent of now the DAX and the SPX, isn't it? It is now testing the 200 period moving average. If we now start closing below it, it'll be a sign of weakness in the NASDAQ, as well as the DAX, as well as the stocks, while the picture in the SPX and in the Dow is completely different. So you don't want to sell those thinking that they're going to catch up. You want to sell the weak first and profit by that. And this is a chart of the hourly Dow. You can see how it's completely different from the chart of the NQ or the DAX. This is still in a hyperbolic phase. No one knows where the top of this is going to be. It could be substantially higher than this. That is why you want to buy put options at some stage, but probably quite a bit higher. But what you don't want to do is you don't want to extrapolate weakness in the NASDAQ to weakness in the Dow. It could take weeks, or it could take much higher levels for that to happen. You want to trade what is in front of you, and that is weakness in NASDAQ, weakness in DAX, and weakness in stocks. If we need a trigger that is going to bring the stock market back down to earth, well, this could be it. The 10-year note is now in a very precarious situation. It has broken back down through this line that we drew months ago, and we could have a much higher level of interest rates in the next few weeks. That is why I've been saying buy straddles in the 10-year note. We could get volatility both on the upside and on the downside. And now we think that the next phase is going to be volatility to the upside towards the 260, 270. And if we break the 262 level, we could go much higher towards 3, and that would be the trigger that brings down the equities market. So volatility in the fixed income market is going to be our possible trigger for very much greater volatility in the equities. Should we be right in the move on 10-year notes? there is a distinct possibility now that the DX index will rally towards the top of this trend channel somewhere around the 96, 97 area. A very good area to aim for is 96.65, where the market has topped many times before. 96.50-ish could be now your A, B, C retracement upwards as US interest rates spike higher in the next 2 or 3 weeks. When we are looking for tops, it's very important to realize that at the moment not a single spread indicator is showing that equities are a sell. SPY TLT, one of the most important ones, is very much in a bull phase and very much shows that equities are going higher compared to bonds. If we think that equities cannot go much higher, then it's probably safer to sell bonds than to play in the outrights in the equities. We can do that through options, but certainly not through outrights, because the market could go well higher. We can't see it. We think that the market is now in a bubble, and it is definitely for us safer to buy puts in TLT and to buy puts in SPY and see which one makes the most money. One of the most interesting markets, which is reaching levels which are very, very significant, actually is Nikkei. Nikkei has broken through the previous top and is now approaching these fork lines, which have been excellent at providing support or resistance. This resistance comes in around the 22,000 level, and that would be an excellent level to buy some puts on the Nikkei for a move back down towards the 18,000 level. Taking a look at the biases, as we said, at this moment it's very important to be long of volatility in the fixed income market, both in the States and in Europe. In Europe we have the ECB coming out on Thursday, and that could be very significant. Levels of 2610 in XPX and 21,900 to 22,000 in Nikkei are the levels where we want to buy puts, and that is what we will be concentrating on next week. The NQ, we're not getting the euphoric action we thought. We will be sellers of NQ if it breaks the 200-day moving average that we showed you earlier. Every market is for itself. NQ is trading very poorly, certainly compared to the SPX and to the Dow. You want to sell the weak market always. You do not want to anticipate that a strong market will turn weak. That is most likely not going to happen for a long time. So you want to sell the weak market. NQ is weak at the moment. That will be our primary sell if it breaks. The same about European equities. We are we are happy to be short of them. 36.15 is the level of our stop, because 36.15 is a very important level in the stocks. If we get stopped, well, it's only 18 points that we'll be losing, and since we are more than happy to be short of the weak markets, we're more than happy to be short of Europe at the moment rather than the States. The DX, as we've been saying that we might get only to 95.07, well, now we think we might get somewhere around to 96.30. Now we think that that is probably going to be as good as we get, but we still have a very long way to go from where we are currently up to 96.30. 93.60 on a weekly basis is still very important. You definitely want to be long of DX if it closes above there, and looking for 96.30. This butterfly is something that we are still exploring where to put on, because we believe it'll work longer term, and we are probably going to have a period that's going to allow us to put it on in size. Thank you very much indeed, and tweet to you on Monday.